Welcome back to Investing Talk Podcast.
Today we are focusing on BigBear.ai. This is a company that calls itself mission-ready AI, and honestly, it's sitting at one of the most fascinating crossroads I've seen in the defense tech space.
Interesting.
It's trading near its lows, but fundamentally, it is going through a complete transformation.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really do appreciate the engagement. Now, let's just address the elephant in the room right away.
Let's do it.
We're looking at a stock that's trading around, what, $4.87? It's down significantly from a 52-week high of over $10.
Mm-hmm.
When you see a chart that looks like that, I mean, it's basically a ski slope going the wrong way.
Mm-hmm.
The first question has to be, is this a falling knife that's just going to cut our hands open, or is this a golden opportunity?
It's the classic question, right? And honestly, this looks like what we call a strategic inflection point. To the casual observer, someone maybe just glancing at headlines, it looks like a company in trouble, revenue's down, the stock's been battered. The buzz seems to have faded.
Sure.
But if you look at where the smart money is positioning itself, they don't see a collapse. They see a portfolio overhaul.
Okay, let's unpack that overhaul idea, because I want to start with the cold, hard numbers. You can talk strategy all day, but if the cash isn't coming in, it's a problem.
Fair point.
I'm looking at the third quarter of 2025. Revenue didn't just flatline. It declined 20% year over year to $33.1 million.
Yeah.
That is a massive drop. Usually when we talk about AI companies in 2025, 2026, we're talking about explosive growth. This looks like the exact opposite.
Sure.
How do you justify a 20% haircut in revenue during an AI boom?
It does look bad, I'll give you that, if you only look at the top line without any context. But that decline is actually intentional.
Intentional. Losing 20% of your revenue is intentional.
Bap.
That sounds like some serious corporate spin if I've ever heard it.
In this specific case, it's actually valid. You have to look at what revenue they are shedding. BigBear is systematically shifting away from what they call episodic services-heavy analytics.
So just think of that as one-off consulting gigs.
Exactly.
Can you give me an example?
Sure. So imagine the government hires you to analyze a specific data set for one specific operation. You send in a team of data scientists, they work for 6 months, deliver a report, and then the contract just ends.
Right.
You got paid, sure, but now you have zero revenue coming in until you hunt down the next contract. It's a hamster wheel. It's low quality revenue because it's not recurring and it doesn't scale.
So they're basically firing those customers.
Essentially, yes.
Yeah.
They're letting those contracts expire and just not renewing them. They are trading that for what they call platform-level products. They want to be a software company, not a consulting firm.
Right. Software you build once and sell 1,000 times. Consulting you have to do every single time.
You got it. They're trying to become a SaaS play software as a service rather than a body shop for the Pentagon. Okay.
And the cornerstone of this entire pivot is the acquisition they completed recently, that $250 million deal for Ask Sage.
Ask Sage. Now, be honest with me. Is this just another chatbot wrapper? Because it feels like everyone has a generative AI platform these days. I could go build a wrapper on OpenAI in an afternoon.
Yeah, fair question.
So why is this one worth $250 million?
It's far from it. This is designed specifically for government and classified use. It's a secure, model-agnostic generative AI platform. You can't just use a standard commercial AI when you're dealing with national secrets.
Under the data leakage risk, right?
Precisely. If an intelligence analyst types a secret into ChatGPT, that data goes to OpenAI's servers. That's a national security breach waiting to happen.
A huge one.
Ask Sage creates a secure orchestration layer. It scrubs and sanitizes the data before it even touches the model, and it allows the government to use any model GPT-4, Claude, something open source safely. It's built for that regulatory environment. So it's the infrastructure. It's like the secure plumbing that let the military use AI without spilling any secrets.
That's a perfect way to put it. And that is a product, not a consulting gig.
Okay, so that's the flagship. But they've been busy in January of 2026. It wasn't just Ask Sage?
No, it wasn't. On January 21st, they acquired CargoSeer, and then just a week later, January 28th, they announced a partnership with Mata Technologies.
And those aren't just random additions. CargoSeer. That sounds like logistics.
They're proof points of the expansion. CargoSeer and Mata take BigBear out of just pure defense and into border security, customs automation, and global trade intelligence.
Which is huge right now. I mean, supply chains are still a mess, and border security is a massive political topic everywhere.
Exactly. They're taking that mission-ready AI, the stuff that predicts battlefield movements, and applying it to supply chains and borders. It expands their total addressable market in a big way.
It proves they aren't a one-trick pony, just reliant on the Department of Defense. All right, I'm starting to see the product vision. Secure AI for complex environments. But I want to stick with the financials for a minute, because there is one piece of news that I see as undeniably positive, regardless of the revenue drop.
Okay.
And that's the balance sheet. On January 2nd, 2026, they announced a massive debt reduction.
This is probably the most critical part of the whole thesis. If you ignored everything else, this alone changes the entire risk profile of the company.
It's huge. They reduced their debt from around $142 million down to about $17 million. That is an 88% reduction in their debt load. For a small cap company, that's life or death.
And you have to look at how they did it. This wasn't them just paying it off with cash they had sitting around.
Right, because they're still burning cash on operations.
Note holders voluntarily converted about $58 million of that debt directly into equity.
That is such a specific and important signal. Let's make sure everyone gets this.
It's a massive vote of confidence. Think about it. If you're a creditor, a bank, or an institution, and you think the company is going under, you want your cash. You want it now.
You definitely do not want stock. Stock goes to zero in a bankruptcy. Debt gets paid first.
Exactly. If they thought the ship was sinking, they would have demanded the lifeboats. The fact that these sophisticated investors chose to convert their debt into shares means they believe the equity is going to be worth more than the debt was. They're betting on the upside.
And from an operational standpoint, it just cleans things up?
Completely. It eliminates those interest payments. That frees up cash flow to actually fund this growth, to fund these integrations we're talking about, rather than just servicing loans. It extends their runway in a big way.
Okay, so we have a cleaner balance sheet, a new product lineup, and creditors are now shareholders. But what's the moat? You mentioned C3.ai. There are plenty of other players. Why BigBear? Why doesn't Google just come in and win this?
It comes down to what they call mission-critical integration. It's not just about having smart AI, it's about where that AI lives. BigBear specializes in the U.S. intelligence community. The switching costs there are incredibly high.
Because of the security clearances.
Clearances, yes, but also the technical environment. They specialize in edge computing.
Define that for someone who might just think of the edge as the browser on their computer.
Right. In this context, the edge means working in completely disconnected environments. Imagine a drone swarm in the middle of a desert storm, or a forward operating base in some valley, or even a submarine.
You don't have a high-speed fiber connection to the cloud out there.
Not at all.
Yeah.
You can't just ping a server back in Virginia to ask, hey, is that a tank or is that a truck?
Yeah.
You can't send your data back to a massive server farm to be processed and then sent back. The AI has to work right there, on the device, in real time, often with no internet at all. That is what BigBear is good at. And that's very different from just running a model in a giant data center like Google or Microsoft.
Okay, that makes sense. High barriers to entry, sticky contracts. Let's pivot to the charts then to see if the price reflects any of this cleanup, because looking at it, it seems the market hasn't fully bought in yet.
It's definitely been a rough ride for shareholders.
Rough is putting it mildly. The stock is in a 53% drawdown from its 52-week high of $10.36. It's sitting under $5. Technically, this chart looks broken.
It is ugly, but I'd call this a technical reset. The valuation has compressed significantly. Right now, the forward price-to-sales ratio is sitting around 12.29.
Which, for a high-tech AI defense stock, isn't astronomical. Palantir trades at what, 20 or 30 times sales, depending on the week?
Exactly. It's actually a modest discount compared to the wider IT services industry, and it's way cheaper than those high-flying AI names.
Yeah.
You're getting the growth potential of AI, but at a much more reasonable multiple than you were a year ago.
And are we seeing any signs that the bleeding has stopped? Is there a floor here?
There are some interesting signals in the noise. On January 24th, 2026, BigBear was included in the Benzinga Stock Whisper Index.
Which usually implies there's some sophisticated accumulation happening quietly behind the scenes.
Right. It suggests that while the retail crowd might be selling or just ignoring it, smarter money is starting to nibble. The chart to me looks like a capitulation setup.
Meaning the sellers are exhausted.
Totally exhausted. Everyone who wanted to sell because of the revenue drop or just got bored has likely already sold.
So when there are no sellers left, the only way is up.
Precisely. Now the stock is just sitting there waiting for a catalyst to reverse.
So the charts look cheap, but what is the street actually saying? Let's look at the sentiment.
It's a mix, honestly. It really is a battleground stock.
It really is. On the positive side, you've got that Maka partnership we mentioned that gets them into the Middle East and AD ports. That's a huge market. And cargo seer. But then on the flip side, there's a lot of skepticism. I'm looking at the Hunter Brook Media report from February 12, 2026.
Yeah, that report definitely added some pressure.
It did. Now, to be fair, it didn't cite specific operational failures. It wasn't a fraud report or anything like that. But it casts doubt. It adds this layer of skepticism right when the stock is trying to find its footing. It basically asked, is the juice worth the squeeze when it comes to their acquisitions?
It does, but you have to weigh that against the macro tailwinds. Look at what's happening in D.C. On February 13th, just a day after that report, Representative Josh Gottheimer introduced a bipartisan bill to create federal tax credits for AI training.
So the regulatory environment is actually getting friendlier.
Incredibly so. The government knows it needs to win the AI arms race, especially against China. They are going to incentivize companies like BigBear. They need these tools to work.
And your point about the debt conversion.
Exactly. I'll go back to it again. Insiders and institutions converting $58 million of debt in 2025. That's a much stronger signal to me than a single media report. People put their money where their mouth is.
That's a fair point. Money talks. But let's take off the rose-colored glasses for a moment. We need to look at what kills this thesis. Because despite the debt cleanup, there are real risks here. This is not a savings account.
Absolutely not. This is a risk-on trade.
Let's talk about execution and margins. I mentioned the revenue drop, but the margins were tough too. In Q3 2025, gross margins compressed down to 22.4%, and adjusted EBITDA swung to a $9.4 million loss.
That is the cost of the pivot.
It is, but it's an expensive cost. Buying growth like that AskSage acquisition costs money. Integrating it costs money. If they don't monetize it quickly, they're just burning cash. They need to prove that AskSage isn't just a cool toy, but a real revenue generator.
That is the primary execution risk, 100%. They have to turn that technology into contracts. They need to show that agencies are signing checks for AskSage, not just, doing pilot programs.
And there's the competition. Risk number 2, the titans. You mentioned C3.ai, but look at Booz Allen Hamilton. They have massive scale and relationships that go back decades. Or look at Palantir. Palantir grew its commercial sector 121% in Q3 of 25. They're a juggernaut. Why would the government choose little BigBear over Palantir or Booz Allen?
That is the billion-dollar question. And the answer, I think, lies in that niche we discussed. Palantir is phenomenal at data integration, taking massive data sets and making sense of them back at headquarters.
Right.
Booz Allen is effectively a massive consulting army. It's people power. BigBear is different. They are the product solution for the secure edge.
So if you need a consultant, you call Booz. If you need data integration at HQ, you call Palantir. But if you need AI on a drone in a desert,
you call BigBear. They're targeting that specific gap where you need productized AI in a classified, disconnected environment. It's a smaller niche than all of data, but it's a niche where they can actually be the leader.
And the government doesn't want just one vendor anyway.
Exactly. They don't want to be entirely dependent on Palantir for everything. They want an ecosystem. BigBear fits neatly into that ecosystem.
That's a key point. Vendor diversity is a mandate in a lot of these contracts. So weighing the debt cleanup against the margin compression and the edge niche against the giants, where do we land?
When I look at the whole picture, the 88% debt reduction, which basically removes the bankruptcy risk, the strategic acquisitions of AskSage and CargoSeer, which modernize the product, and that valuation discount, I am giving BigBear.ai a bullish score of 7.5 out of 10.
7.5. Okay, so that's a cautiously optimistic score. You're not betting the farm, but you're definitely interested.
It is. This is a 12 to 18-month hold. The entire thesis relies on this strategic pivot working. You are betting that the revenue dip was worth it to get to this better business model.
So what are the specific catalysts we should be watching? If I buy this stock today, what am I looking for in the news next week or next month to know if it's working?
First up is Q4 earnings, which are likely coming in March 2026. We need to see proof of AskSage integration. We don't necessarily need massive profits yet, but we need to see that the technology is being deployed and that the bleeding on the top line has stopped.
Okay, so March is the first test. What's next?
Then mid-2026, we're looking for what they call the OB3 government funding wave. There's an expectation of new contract wins coming out of that cycle. And finally, we need to see that MATA partnership actually turn into a deployment. If they can show they're winning in the Middle East, that proves the global thesis.
So it's an asymmetric bet. The downside is somewhat protected because they cleaned up the balance sheet. They aren't going bankrupt tomorrow with only $17 million in debt. But the upside is fueled by this massive surge in AI spending we're all expecting in 2026 and 2027.
That's it, exactly. You're buying a company that has already taken its medicine. They've done the hard work of restructuring. Now they just have to execute.
Well, there you have it. While it's risky, that debt reduction really does make this a serious turnaround candidate, not just another distressed asset. It's going to be a fascinating year for Big Bear. One thing I'm going to be watching, as warfare becomes more autonomous, the company that owns the brain on the drone might end up being more valuable than the company building the drone itself.
Definitely one to keep on the watch list.
So don't forget to subscribe, like, and comment to let us know if you're buying the dip on Big Bear. We'll catch you in the next one.